Hi, everyone. This is Jason Bierk of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. He's a gold and silver expert. He's been managing money professionally since 1992, investment and portfolio management business. He founded Profits Plus Capital Management, a registered investment advisor in 2001. He also has Idaho Armored Vaults. It stores physical gold and silver outside the financial system in insured, segregated, and armored vaults. And I believe he also has a retail gold and silver bullion dealer too, with discounted prices compared to a lot of the more well-known ones. I won't say some of the names, but there was huge markups on premiums on gold and silver bars, and he was offering them at reasonable prices. Bob Coleman of Profits Plus Precious Metal Management. Thank you for joining me again.
Thank you, Jason, for having me.
So, Bob, we're recording this interview on Monday, March 25th, 2024. The paper gold price in US dollars is around 21.70. The silver prices are down a little bit below 25 at $24.64. The last couple of months, we've had a nice rally in the paper price. Do you think a lot of this divergence between GLD, SLV, and the paper price in dollars, does a lot of this have to do with demand out of China offsetting the paper markets?
Yeah, I think initially China, as well as the central banks, have been sort of the tailwinds to the markets, whereas the Western investor really has seen the stock market melt up. You've seen the digital currencies or the digital asset market melt up. The real estate market hasn't crashed, so you have confidence coming back into the financial markets, where these institutions in the Western world, and as well as retail investors, say, listen, maybe things aren't as bad as I thought they were going to be, so I'm going to dive back into the stock market, or maybe some of these assets that I ran away from 2 or 3 years ago and went into the metals. Now I'm going to diversify back out of the metals and back into these other assets. Along with treasury bills, earning 5% plus. There's more competition for the metals at this point.
And you put out a recent article called Gold and Silver ETF Flows Diverge with Price. We've just had absolutely enormous increases in physical gold and silver demand in China and India. Do you think this is sustainable?
Well, from their standpoint, it's a confidence game over there, and with India, you have to look at their industry. They've been bringing in a lot of silver the first 2 months of this year. In fact, I think that their numbers the first 2 months of this year, I think, overwhelmed, I think, the entire demand from the U.S. All of 2023. I mean, you're talking some big numbers, and some of that's probably going into industry, as well as bars for their newly created exchange. But I think, like with China, obviously there's a confidence factor with real estate and the stock market being very frustrating to own over there, as well as some of the debt issues. People are trying to gravitate to something that's going to be, that's more tried and true. And that flow of money has just been absolutely incredible. And you've seen the export numbers coming out of London, out of Switzerland. There's been a lot of metal that's been gravitating to the east. So that's kept the markets very firm. But at the same time, in the U.S., so you've had the CTAs, which are the commodity trading advisors, up until mid-February, toward the end of February, they took very sizable short positions, especially in silver. They were almost $1 billion or over $1 billion notional short, or notional value short, the market. And I put out a post, I think I pinned it to my Twitter account, looking for the potential for the mother of all short squeezes potentially developing here, because there is just it's sort of I guess a lack of any faith that the metals can move up. Now, since that took place in mid-February, there's been a sizable shift back to the long side amongst managed money and the CTAs, not only in silver but also in gold. And I think that's this realization that, well, wait a second, with all the spending in the U.S. and this fiscal dominance position, and there's really nothing to shackle the spending and money creation and debt creation. So you're almost having this melt up of almost all assets at this point. And the question is, how sustainable is it? what happens if the dollar starts to move lower, and then people that are caught short or that have been sort of staying away from the market, when does that start to draw those people back into, for example, the metals themselves?
In terms of sustainability for Chinese demand out of the private sector, I think that's a key point you brought up, is that there's been a lot of articles the last month or so, whether it was the Financial Times or the New York Times, citing Chinese fund managers at the institutional level, Chinese real estate investors, Chinese retail investors, that they've lost faith in a lot of Chinese stocks and Chinese real estate. The other issue here is how the Chinese government and their central bank decides to deal with their real estate debt, the banking problems with real estate prices falling. Will there be a devaluation of the Chinese yuan? So if there is a sizable yuan devaluation coming, and I don't know if it's in a couple months or 6 months or 12 months, but if there is a devaluation, and I've spoken to a lot of China experts recently, and they think that there could be, and a lot of people in China think that there could be, if there is a devaluation of their domestic currency, they're not going to want to hold a lot of their savings in Chinese yuan. We know this in financial history. They're going to want to buy real stuff. And if they don't have faith in the normal asset classes like stocks and real estate, I think gold and silver are some of the only options given the capital controls.
Yeah, I think you're right. And actually, what's odd is that the Chinese government has been supportive of promoting gold and silver ownership. So there you have sort of this almost this lack of faith that's being that's being reinforced by the government themselves. And then the other thing is geopolitical concerns. I mean, there's obviously the markets. Nobody really riots or protests if the stock market's going to all-time highs or it's rising and your retirement portfolio or your portfolio is going up in value. People become very patient and they look past a lot of the frustrations of life. But if China is not able to turn around their stock market and real estate market, and it goes into another drop, for example, or for example, Hong Kong goes into another pullback or something of that nature, and you start to see frustration develop. At that point, you have the concern that the government says, okay, we need to create some other type of, whether it's going to be devaluation of the currency or potentially some other type of geopolitical event to show strength. And that's a big concern when it comes to Taiwan.
There's an article that came out in the last couple of days by Jan Nieuwenhuis. He used to write under the name Koos Jansen. He says that China has taken over gold price control from the West. I don't know if his numbers are accurate. Not sure if you can verify any of these as well. He says the People's Bank of China has bought 735 tons of gold in 2023. We know that officially they've released publicly that the last 16 months in a row, I think, that they've added net tonnage. I don't think it's a 735 number, but we do know that in January of 2024, the private sector demand that China imported, I think a lot of it was for Chinese New Year, but also because of the potential for a yuan devaluation and the other asset classes in China, the main ones not doing as well. That caused a record amount of gold imports. Wasn't there also a huge increase too in the Swiss export data into India? So it was gold and silver also going into India as well.
Correct. Yeah. India saw a massive increase. In fact, I think it was, if I'm not mistaken, I think the export data out of Switzerland for gold, I think literally half of it went to India, and then half of it it was either India or China, and the other half went to the United States. I think it was China on the gold side, if I'm not mistaken. I should say that the two biggest exports were to China and to the United States.
Now, really, in the last 12 to 18 months, we've seen, I would say, a paradigm shift in central bank gold purchases. Do you think this has to do with the spending out of DC, the budget deficits, and the supply and demand issue for U.S. Treasuries, that these foreign governments and central banks, especially outside the G7, so the countries that are not like Japan or European Union, United Kingdom, are saying that DC is spending way too much. We already have enough treasuries, and we do not trust DC to limit the budget deficits.
Yeah, I think partly there's that concern with a loss of confidence. There's also the concern, like with you know, not to say that some of these countries that are buying gold are going to do what Russia did, invade a country, but it's the sense that your treasury isn't really your own asset anymore. It's still the ownership of the U.S. Treasury, and they can dictate whether or not you can maintain ownership. And so there's this idea that you want to be sort of you want to lessen, I guess, the counterparty risk perspective, and own an asset that really has no one else's promise to pay. So that, I think, that kind of starts to seep into the markets. I think it's also, countries around the world are realizing, with this sort of massive debt spiral that we're kind of, or instead of spiral, I should say, instead of this massive debt tsunami that we're seeing in the marketplace, just constant more and more debt, more and more spending. Yeah, and it's not just happening in the U.S., but it's happening in countries all over the world. I think central banks are saying, listen, we need to anchor our balance sheet, in order to potentially, from a, and I think it's more from a collateralization standpoint, that we need to have a neutral reserve asset that eventually, if it, that we can, that can rise in value, that neutral reserve asset can become a sort of an asset of that can be used for collateralized purposes.
And I think budget deficits over the last 12 months, they're around $2 trillion officially. Going forward, I think over the next 12 months, they're going to be even larger than that. The Biden 2025 fiscal budget projections, they have budget deficits around 1.8 trillion. But before we started recording, I mean, they're assuming that they could just easily collect another $1 trillion as tax receipts. If that is not true, that assumption is not true, you're looking at budget deficits around $3 trillion. They're not counting interest payments at a higher interest rate on the national debt being added into there too. I mean, I've seen estimates that the budget deficits over the next 12 months could actually be closer to $4 trillion. And then on top of that, we're still adding with the total debt that needs to be rolled over. It's the debt's being added another $1 trillion every 100 days. So the projections from the Congressional Budget Office, the Biden administration, Congress are absolutely nuts. They're not accounting for reality at this point.
All I can say is it's insanity. I mean, to give you a perspective of $1 trillion, and I was told this example by someone that's been in the markets a long time. But say you opened a business up the day Jesus Christ was born, and that business just was the worst business in the world, and you lost $1 million a day every day till literally to the present day. Losing that $1 million a day still wouldn't take you to $1 trillion. I mean, we talk about $1 trillion as if it's a $20 bill in today's world. I mean, you're talking massive amounts of money in debt that will never be repaid back unless obviously it's inflated away. And that ties you back into the reasons for gold and silver as assets of choice over the long term. That I think a lot of investors tend to lose focus on, because obviously everyone likes to make quick money, or they see momentum trades, or they see trend, or they see other types of relative valuations, or they're gravitating to whatever is hot, so to speak, or whatever the media wants to pump, like whether it's AI or technology, whatever it may be. But I think over time, that's where gold and silver provide a lot of stability. I think an anchor to a portfolio during these times where you just have things that are just so insane, they don't make any sense. And at some point, that's what you kind of think, well, it's going to be unsustainable at some point. You just don't know when that point is. And that's where I think the metals kind of offer a little bit more stability and a little bit more sanity.
Well, foreign central banks have limited options, so they can either buy with their reserve assets, either U.S. Treasuries or gold tonnage. They don't have a lot of other options unless they create like a sovereign wealth fund and start doing like a technology hedge fund like the Swiss National Bank did after they ran the Euro peg for 3 years and created 300 billion out of thin air. And I think at one point they owned 40% of all the Facebook shares.
You're just dropping mics everywhere.
Well, I mean, the average person doesn't pay attention to all the crazy stuff that's happened the last 15 years. It's just, I'm kind of numb and desensitized. We were talking about all the crazy stuff in DC, and literally they just, at 2 a.m. a couple days ago, they just did another 1.2 trillion or something of spending. And it's just their budget deficits are blowing out, but there's not immediate hyperinflation risk, but they've kept things in kind of like a stagflation range where the average person on business television just says, "Oh, inflation is coming down. Oh, it's not a big deal."
Right, and that's the deception of inflation is, initially everyone loves it because asset prices are rising. People feel like they're actually becoming richer, and it's hard to argue that. The problem you run into is it's the cost of living that finally starts to become that inflationary situation becomes toxic, and I think that's what we're seeing. We were talking about Bitcoin mining, and for example, the cost of insurance and some of these other business expenditures, cost of electricity. These things start to rise. You can't hide that, and that's, I think, it with the physical metals. I think there's been a lot of management of price over the years to kind of, and that management price doesn't necessarily mean manipulation, so to speak. There's ways you can manage price through the ETF structure, through the paper markets, through collateralization, financialization, through derivative products and things like that, structured products that become financial sponges that soak up capital that would otherwise go to hard assets or commodities. As long as the government and the markets can create these other financial products that would soak up that liquidity that would otherwise drive these hard asset prices to new all-time highs, you can mask this theme of inflation. Things aren't really that bad. Price of oil isn't at 150. Look, it's only at 80 a barrel, so to speak. But if you look at cocoa prices, for example, and you have a dislocation in supply and demand, a true dislocation in supply, you can't hide that anymore. I mean, so that's the financialization of all these financial products is what really has created this ideal management of the markets, and to keep certain assets down in price, I think, while they can maintain higher asset prices that attract the investors, the stock market, the wealth effect, so to speak, and drive more tax revenue base.
There's also a lot of accumulated inflation. We see this with the average person when they go out grocery shopping or out to a restaurant. It's not being covered in the consumer price index, or as I call the CPI, or changing propaganda index. Do you see a lot of US and Canadian retail investors starting to come back into gold and silver with coins and bars now that the prices are starting to look better?
Well, they're coming back, but they're selling. You've seen, really going back into probably about 6 months ago, and I was reporting on this back then. You started to see the dwindling of really the summer of last year. You started to see demand start to drop off, but it wasn't. You started to see the trickling of selling coming into the market, but really by October, November, the selling started picking up. Premiums were collapsing, bids were collapsing, the price at which dealers were buying back product. All you have to do is look at today's bids on a lot of these big online dealers, and they're bidding $1.20 to $1.50 under spot for a silver 100-ounce bar that they were charging $6 over spot maybe a year and a half ago. I mean, that's destroying people's purchasing power, and people are seeing this. They're frustrated with the metals. They haven't gone, anywhere. Well, I shouldn't say gold's gone up, but silver has been very frustrating known. They paid a massive premium the last 3 years, listening to promoters saying silver's going to $200 in the next 6 months. Well, it just never unfolded. And people saw everything else melting up. And so it's natural for people to become disenchanted with one asset, sell it. But the danger to that, though, is they may never come back. And I think the industry, did itself a massive disservice by profiteering off between 2020 and 2023, the massive amount of money that they made off of these markups in multiple products. And the way they fearmongered and sold to the public this idea of shortages and so forth, I think if they would have managed that better and not profiteered, like the gas station that during the hurricane, the one that has the last gas available, they just mark it up to whatever they want to. I think you would have had I think a market that would be broader in nature, and I think more people would have been willing not only to invest one time, but they would have invested multiple times. I think a lot of people, they bought into this being new to the market, not understanding these markups and the spread risk. Now that they've seen the spreads completely collapse and the bids, go to discounts to spot, they're saying, what value does the metals really have? And that's the frustration that I've been seeing really the last 3 or 4 months.
Especially when Nvidia, these artificial intelligence stocks, Bitcoin prices. I mean, the US and Canadian retail investor, they're not interested in gold and silver right now. It's very negative. The sentiment is extremely negative. I mean, I had bullion dealers trolling me on Twitter from the US in the last couple of weeks. And then others, anything you say nice about some of these gold and silver producers, but the cash flows over the next couple quarters for some of these precious metal royalty and streaming companies and miners, they're going to be there. It's just the retail investor is not interested because, like you said, they're chasing price that they gotten burned. I think that what the premiums for silver eagles, I don't know if they've come down. I haven't looked lately. They were like over $6 an ounce for the silver eagles.
Yeah, I mean, I think on average, I think there's still like, a lot of these online dealers are 30-40% premiums in certain regards. I think I'm at 17% in terms of my premium for silver eagles. It's like $4.05 or something like that over spot. So I've always been one of the lowest out there since I've been doing this on the metal side since 2009, selling metals, and we deal not just with the public retail side, but we also deal on the institutional and high net worth investor side. So we can move size and provide relative pricing as well for larger purchases. But that's one of the things that I wanted to kind of use the social media side. It was to try and kind of get out there yelling at the rooftops to at least try to shop around, especially the last 3 years, because there was just so many dealers out there that were saying the same thing, using the inflation narrative or the shortage narrative, or and kind of getting away with that and getting the public fixated on simply, hey, the price is going to go up and you got to pay whatever you can to get it right now because it's insurance. But they ended up, what they did was they just basically gave away their own purchasing power by paying too much for the product.
You got to wait for the premiums to come down. Like, people have asked me, when is the right time to buy gold and silver? I say you look at the premiums and you track the premiums. So if the premiums are trending downward and the sentiment is bearish, that's kind of the time to start accumulating. You do not want to pay those high premiums. But unfortunately, the people who get into gold and silver, the first thing they do, they start seeing those YouTube videos and the podcast predicting immediate shortages, much higher prices, and they pay for the sky high premium. So that's like the main mistake that a lot of newbies make.
Yeah, it's that, and it's also the practice of the industry. There is some very and the CFTC and some of the state attorney general offices, as well as Department of Finances, have come down on a lot of these dealers that have predatorial type practices going after the public, the retired and elderly. It's very unfortunate to see these 40 to 100% markups on just bullion products that of people that are completely unsuspecting. They don't understand the markup structure. They're being told to buy these small bullion coins of limited production, but they're being sold as if they were collectibles or numismatics, and it's unfortunate to see that, and that only puts a more of a black eye on the industry as well. So the industry needs to clean up that image a little bit, and try to promote a much more transparent type of platform in terms of pricing, and also education of why to own these metals in the first place. It's too many people were saying gold's going to 10,000, and if you want to learn how, subscribe to my newsletter, or the banking system's going to collapse in 2 weeks, and if you want to learn more, it's $1,200. I'll tell you everything you want to know. I mean, that type of mentality just puts a very bad taste in the public, especially in the perception of the public, in terms of the conflict of interest, and what are these people actually really trying to sell or promote. And that's the unfortunate thing. I think if the industry can kind of adjust here and learn from its ways and try to promote a healthier market environment, I think it'll gravitate and bring in more of the Main Street. But the sad part is, people chase price, unfortunately, and the price of the metals have to start moving higher, I think, in order to see the public, start to feel more confident about getting into the metals. The downside to all that is, as the price goes higher, and this is something that I mentioned back at the Silver Symposium back in October of last year, was my theory was, as the prices go higher, the public has bought a lot of metals over the last 3 years. In fact, the public has bought a lot of metals really since the financial crisis back in 2008. You have a lot of overhead supply that's going to come into this market from people that are just been sitting in this thing forever, and in their lifestyle, when they bought silver, for example, back in 2010, 11, 12, there were more Silver Eagles being made back then than there were each year in 2020, 21, 22. So you have a lot of overhead supply. Well, a lot of those people are now older, 15 years older, and they need income off their portfolio. They can't wait for the metals to continue to, whether or not they're going to go up or down in price. They need more consistency, and I think that's going to be a driver of selling into this marketplace. Now, you have to remember, the selling of retail product isn't going to drive the spot price, but it'll drive the premium and discount structure and spreads that these products are based off of. So that's what I tried to explain to people as far back as November of 2022, doing a Spaces on Twitter, talking about the risk of spreads and premiums coming down hard, and that being a risk to your portfolio.
I also think Western retail investors selling coins and bars, it's not going to affect demand out of China or India. I mean, you have central banks that are buying in tonnage, gold tonnage, and then you have like way more people in those countries, China, India, Turkey, that are accumulating physical metals. So the demand on the demand side for physical is offsetting Western sellers. But I think it's a key point that you brought up. There is a lot of capital that's leaving the gold sector and silver sector. There's a lack of capital raising for the junior mining companies, and that capital is going into technology stocks and Bitcoin. It's gone away from funding these junior mining companies that are outside of mining stock ETFs, and it's chasing prices higher for whatever asset class here in Western capital markets, U.S. stocks or crypto or whatever, is going up.
Right, and that, what you just mentioned, it builds the foundation of a bull market. Oddly enough, the lack of capitalization going into the mining sector that produces this metal that would come onto the market, you're already seeing it. You're seeing supply production declines in multiple countries. You had some, due to the mining strikes in Mexico last year, you saw a big drop in silver output, for example. These are all positive factors for the bullion price itself, just like we see with cocoa prices going absolutely through the roof because of some of the supply destruction and poor growing seasons this past year with regard to cocoa. You're going to see the same thing happen. The cure for low prices is low prices, basically, and that's not something to get frustrated on as an investor in the physical metal. That might be something to be frustrated on if you own a mining company. And I think that's one of the reasons why mining companies have been such poor performers over the last few years was, their inflationary costs of running a mine outran the inflationary price rise of the product that they were mining. And I think that's I think shocked a lot of people, and it obviously it was very, you could see it very clear in their financials and cash flow statements.
Exactly. Let me add here some additional points. You have the mining costs. They're still rising for a lot of these miners, 8% to 10% per year, like clockwork. So the costs that are rising quickly may change. It could be labor costs. It could be cost of capital. It could be energy or electricity costs, diesel costs, materials to build a new mine. I mean, these costs are up significantly, especially over the last 3 to 5 years. Some of them are up a lot. We do not have a lot of low cost gold, silver, and copper mines. And then the other major point you brought up, whether it's Chile, copper production, and people are like, well, why copper production? Well, because gold and silver byproduct, that's the majority of the supply. So it's from copper and base metal mines that we have silver and gold. It's the majority of the annual supply is byproduct.
Right, and one of the other things too is political. The political reality of a country that wants to go more green, so to speak. You've seen, and it's obviously election year in Mexico, but they were talking about the idea of banning open pit mining. I mean, that's you're talking a lot of metals are mined through open pit mining. I mean, that would be a tremendous destruction of production there if that ever took place.
Well, even if they don't, I mean, I think the cost for the environmental, the application licenses, I know Fortuna Gold and Silver, they had to pay more to get their environmental licenses back for the San Jose silver mine. But you have the overall trend, whether it's copper supply or silver supply in countries like Chile, Mexico, Peru, Panama. I mean, it's trending down enormously the last 5 to 7 years.
Right. Yeah, and just like with silver production peaked back in 2016. So it's not even with this ramp in price, for example, versus where it was in 2016, you're not seeing this ample rise in production. And I think, in fact, it's kind of odd because a lot of the primary silver producers now are primarily gold producers, on their balance sheet. 70, 60, 70, 80% of their production and revenues are coming from gold production, not silver production.
Well, they had to. The profit margins are better for silver mining. I mean, if they only mine silver, a lot of them would be bankrupt already. They had to. They didn't have a choice. The profit margins are better for gold mining.
Yeah, and that's again one of the things that you tend to see with silver that's very supportive with price is if it's at the cost of production, it tends to over time that tends to be a floor for the price of the metals. And I think that's one of the that's where we kind of hit this pinnacle, I think, back in mid-February, where everyone was just throwing in the towel. The mining stocks were going right into the toilet, and people were being very frustrated with the entire sector. And you were seeing silver miners, trying to, curtail production, roll forwards, where they did want to lock in prices because the prices were too low, or they just weren't making money on bringing that product to market. That all kind of culminated into this, this sort of low or bottom of absolute sentiment, and I think that spawned where the rally started from. And so sometimes when you're watching technical analysis, you're watching moving averages, sentiment, stochastics, whatever it may be, but you're looking for any type of crumbs that you can find in the marketplace that try to give you any type of inkling of, okay, are we at some type of extreme? And I think February we saw another one of those extreme sentiment measures that marked a very firm low in the marketplace, and it was a great launch pad to start moving it higher. And that's where obviously a lot of people that were short or not invested at all got caught sort of flat-footed and had to change their they got forced basically to either go back into the market or cover their shorts and unwind their position that was betting against the market.
Yeah, you talked about in some of your articles over the last month that there was a huge short squeeze coming. I think in the past, Bob, there would have been a couple months ago, there would have been a crash in paper prices for gold and silver, and we would have had gold prices around 1,700, silver prices would have been back around 18. But because of all the increasing costs for mining supply. I mean, silver below 18, a lot of the primary silver miners are potentially bankrupt. Gold prices at 1600 or below. I mean, there's a lot of higher cost mines in production now for 15, 14, 15, 1600 costs. I mean, those gold miners would be in trouble. There's just not a lot of cheap mines available. The other major point here, I think you've tried to summarize the last couple of minutes, with all these rising costs, the cost of capital, lack of investment into the sector, we're not going to see a lot of new supply soon. It takes years to bring new mines online. And especially because gold and silver, a lot of the supply is from byproduct, you need a higher copper price. So if the copper price was not doing well, I mean, if the copper price is at $5 or $6 and it stays there for years, okay, they're going to bring on they're going to bring on a lot of new copper mines, and then that'll be new gold or silver byproduct. But if the copper price doesn't stay high too, not a lot of incentive then to bring on those new mines with gold or silver byproduct.
Well, and it's not only that. I mean, when you're talking base metals, you need an economy to be growing as well. And that economy in today's world means either more money printing or more debt creation to then be converted into money, and to drive an economy or to drive infrastructure spending, that type of thing. So we're now caught into this larger loop where it's almost like, especially in election year, where you have to literally keep your foot on the gas pedal from a loosening standpoint in terms of monetary policy and fiscal spending, to allow asset prices to move higher and higher to gain, more electoral advantage, or I guess, people vote with their pocketbooks, so to speak. I mean, it's the old adage. And so, if you can melt the market higher, everyone becomes, sort of, it appeases the voter, so to speak. But the sad part, though, is unless you keep that spending going, these infrastructure projects that's going to require those base metals, you're not getting it from probably the private sector. So it's really being done through the public sector. That's creating the demand for a lot of this base metal mining. And that's the unfortunate thing, is a lot of these miners look at demand and production numbers, and they the price doesn't really mean as much as, hey, what is demand going to be? What do we expect that's going to have? Because like you said, the price can go up and down. It can go up one month and down the next, and to try to gauge a mine that's going to take a year to build out or start producing, you can go bankrupt if you time it wrong. So I think looking from a mining, running a mine is there's so many more
factors or inputs.
Yeah, exactly. Yeah, definitely.
Well, the U.S. right now, the Federal Reserve Bank in D.C., they've kept things kind of, on one hand, they've kept interest rates artificially high, and they've made problems in the real economy. They've made it bifurcated. They've kept the asset prices from crashing. But now there's an inflation problem, so they can't cut rates because the inflation data temporarily, at least, is looking hotter than expected. But I mean, eventually this is going to start to break a lot of things. It's breaking the consumer right now. It's going to break commercial real estate. These things are regional banks. These things are going to break. I guess they're hoping that things don't break until after the election, though.
Yeah, I think it's one of those things that if we could just get by, you see a lot of it with day trading. If you could just get to the market close and break even, we don't care about what happens tomorrow. But it's the concern is that again, the toxicity of inflation, it's the melt up of the cost of living that you cannot hide from the public. And eventually that seeps into the business climate of small businesses and medium-sized businesses and large businesses that says, okay, our costs are rising so fast, we're going to have to lay people off or somehow reduce expenditures to maintain some form of profitability. And you're seeing what's interesting, like in the precious metals world, with the industry taking on a lot of inventory right now. A lot of dealers are up to their eyeballs in inventory, and as prices go up, it's bringing in more selling. But what you're seeing in the marketplace is there's other sectors that are seeing the same phenomenon, where you're seeing inventory of, like, for example, cars, that were, going through the roof, during COVID. You're starting to see a lot more inventory out there, so and in other products. So you can see the private sector sort of slowing down, or maybe you're seeing a shift, to other asset classes or spending patterns. Maybe it's because the cost of living is going up so much, especially like with
Well,
insurance.
Well, cars I think are different though, because a lot of people need a car loan, and with these interest payments, where interest rates where they are, and the monthly interest payment on the debt, I mean, a lot of people can't make the monthly payment. So I think like it's interest rates, and car loans specifically. You're seeing that with mortgages too. A lot of people can't qualify for a mortgage at the higher interest rate.
Yeah, I mean, typically, I would say, the real estate sector can be also very interest rate sensitive as well. But yet you're seeing the real estate market, or I should say residential real estate, at least the government say, hey, listen, there's nothing wrong here. Things are only getting better. Which, yeah, that's, I guess, when you look at any government statistics, you have to kind of take everything with a grain of salt. But the key the point that I was trying to make is, as costs rise, people have to divert that discretionary spending that they may have used for investments. They may have to now apply that toward higher health insurance premiums, or higher car insurance premiums, or their house insurance, or other costs like electricity and utility expenses, whatever it may be. That starts to
Grocery
sink
bills,
away.
yeah, grocery bills, meat, food, yeah, all those things are up, yeah.
Yeah, and that part is what starts to drive away from discretionary spending, and that's ultimately what starts to hit the economy, and then eventually that starts to snowball. And that's what we're kind of seeing with higher inflation rates. And you're seeing, the insurance market, major insurance carriers just walk away from California because it's just too expensive. They can't make any money. They're losing a fortune trying to underwrite properties. There's no payback.
Then you have the budget deficits in DC, so they're claiming inflation's coming down. The average American knows inflation's not really coming down that much. That their cost of living is going up, and there's many years of accumulated inflation, and it's starting to build up. And that's why foreigners are deciding, hey, wait a second, these budget deficits, the inflation already in the system, we're not being compensated accurately, especially buying 20 or 30-year U.S. Treasuries. And that's why a lot of foreign governments, besides the Russia sanctions, they're seeing the budget deficits. They could be upwards of 4 trillion annualized. And I think that's why gold tonnage. That's why these non G7 central banks each month, a lot of them are buying gold tonnage.
Yeah, definitely. The old adage, keep it simple, it comes to mind. The one thing also about inflation that I think the public understands, but as the inflation rate comes down, the politicians like to use the adage, oh, look, inflation's coming down. But what's sad is the inflation rate is still positive. It may not be 5%, it may be 3%, but it's not coming down. It's not negative. And so the cost of whatever it was from the year prior is actually just 3% higher instead of 5% higher. And that's if you believe the government numbers. But that's the frog boiling in the pot of water slowly syndrome. Is that the politicians can wrap it in a bow in a way to try to kind of soothe the public that says, okay, things really aren't that bad. But the public realizes, hey, listen, I'm under a lot of stress here. Don't tell me there's no inflation because I feel it, and I think that kind of ties it together.
Well, I think there's decades of accumulated inflation. I would argue that the real inflation rate for over 20 years has been over 2%. And over a long period of time, I mean, that adds up, that compounds. And then you get to the point where you're paying out of $50 for a steak that used to be 15, 20 years ago, under $20.
Yeah, no question about it. I mean, it's again, that's where the paper world, I think, does a job of masquerading, certain asset prices from showing true inflationary type of moves in overall cost of living structures, that type of thing. But I think the oddity is the central banks realize that there needs to be some diversification here. There needs to be some anchor to their portfolio that they kind of see what's headed down the road. They're not obviously these guys have to manage not just their own balance sheet, but they use it from a balance of payment structure. They have to be able to do swaps and other types of transactions to support their own economies, and so they have to be on the right side. And by accumulating more gold, I think it's a sign that says that they expect these costs of living and these other types of adjustments that's being done by money printing and deficit spending and so forth are going to start impacting the economies around the world as well as trade.
And they expect the dollar to be devalued, and they do not trust the budget deficit spending and the growth of the national debt, because I think the Congressional Budget Office is actually assuming that the national debt will only increase by $10 trillion over the next 10 years, which is ridiculous considering the pace we discussed earlier in the interview. It's growing at $1 trillion every 100 days. So the CBO is definitely wrong, but it sounds like there was political pressure there applied by Congress or the White House, someone up there telling them to make the low end estimate like that, which is absolutely ridiculous and does not reflect reality.
Yeah, and again, this is the election year, so there's going to be a lot more exaggeration of numbers and spending habits, I think, than you would traditionally see during a non-election year.
Agreed. Whether it's GDP or inflation data and the consumer price index or the jobs reports, which are basically cut in half every 1, 2, 3 months later. So we're seeing all these games here. I think with the money supply, I think they're printing way more money and doing way more bailouts with the money supply numbers than they're claiming. And yet they're also keeping interest rates high, which is hurting the average American and small business owner, because a lot of us don't have a couple $1 million in our checking accounts to go and get those 4.5% on short-term U.S. Treasuries or money market funds.
Sure. Yeah, it's certainly, you've seen the wealth inequality really start to widen out, especially and I think partly that's one of the reasons why I think a lot of the younger audience goes after the crypto market, because of the hot money and the big moves that can come about from this asset class. There's this feeling of frustration of like, hey, listen, I gotta do something here, and owning an average portfolio of S&P 500 stocks isn't going to do it for me if the price of a house is going up X, and I'm only can get Y, which is a smaller amount from my stock portfolio. So you see a lot more risk taking.
It's YOLO, it's FOMO. They're trying to get rich quick, and they're gambling. I mean, in the short term, it might pay off. It's not diversified, but there's a lot of people, younger adults, and we were discussing this before we started recording. They don't want to be diversified in stocks or buy gold and silver or buy stocks like oil producers that have dividends or gold and silver companies that are going to have good free cash flow in the next couple quarters. They're chasing Bitcoin higher. They're putting way too much of their savings, if they have savings, into Bitcoin. And this is the gambling, the speculative casino that we have now that Warren Buffett has talked about recently.
Yeah, and being in the markets since 1992, I've seen a lot of the bubbles and the massive inflationary or inflation or high prices of certain asset classes dominate the headlines and the media and the perception of investors. Yeah, and I don't see, oddly enough, the type of speculative fever that we see, especially in social media, is rampant in the digital asset space. And oddly, you're seeing. I think even J.P. Morgan put out an article, or was mentioned in an article, in a research report. I'm sorry, that a lot of people were saying that the Bitcoin ETF flows were taking away from the gold flows. But J.P. Morgan came out and said, no, that's actually not the case. The gold flows have been coming down irregardless of whatever the Bitcoin ETFs were doing. So you're just seeing an asset class, like especially with digital assets, kind of captivate the investor audience currently. That doesn't mean it's going to captivate them 6 months from now. And typically, when these markets shifts, and they all move in cycles, and when you get to this, like the spending that you've mentioned, when you start to see more uncertainty develop in the marketplace, typically hard assets is where investors go to during times of uncertainty, and I think you're going to see that unfold in spades over the course of the next year or so with the metals. I think you're seeing the setup form, the base being built, the foundation, the consolidation, the breakout with gold, into the 2100s. Silver has been coiling for some time now, and this coiling action typically you see a very strong move. And the question obviously is, if this coiling action has been basically a consolidative base, and when it launches, silver tends to really outperform. It starts to go up like a hockey stick relative to gold. And I think with gold breaking out, I think it's at some point it's telling us that whether it's the inflationary acts of the federal deficit spending and money creation, or if it's just this uncertainty amongst the public, or this lack of confidence or lack of trust that's starting to potentially build into the marketplace. I think that's what that could really launch the metals going forward, into or after the election.
And along with bailouts for commercial real estate and office space, I think in the next year or two, we're going to see that as well. And I think the bailouts and the money printing for that will also be bullish for gold and silver. So we'll have to see. We'll have to have you back on again, Bob. I want to thank you so much for your time. And I'll attach a link to Idaho Armored Vaults, Profits Plus, and a link to your Twitter.
Sure. I appreciate it. Thank you.